Hey everyone, welcome back to the channel. Have you ever looked at the stock market and just thought, how does this even work? One day it's soaring, the next it's plummeting, and it all feels a bit random. But what if I told you it's not as random as it seems? What if there are powerful forces, the real puppet masters, pulling the strings behind the scenes? Today, we were diving deep into the shadowy world of Wall Street to ask the big question. Who really controls the stock market? To understand who's in control, we first need to get a grip on what the stock market is supposed to be. In a perfect world, it's a level playing field. Companies sell shares to raise money, and we, the public, buy those shares, hoping the company does well so our investment grows. It's the engine of capitalism, driven by supply and demand, company performance, and a bit of collective optimism. But as we all know, we don't live in a perfect world. The reality is far more complex and a lot murkier. So, let's talk about the big players, the ones with the power to move markets. First up, the giants, institutional investors. Think massive pension funds, mutual funds, insurance companies, and university endowments. These aren't your average retail investors buying a few shares on an app. We're talking about organizations managing hundreds of billions, or even trillions of dollars. When they decide to buy or sell a stock, they do it in enormous blocks. Their transactions are so huge they can single-handedly cause a stock's price to surge or collapse. It's like a whale jumping into a kiddie pool. It's going to make a splash, and everyone else is just along for the ride. They have teams of the world's best analysts, access to incredible data, and direct lines to company executives. Their influence is immense and, for the most part, perfectly legal. Next on our list are the investment banks. Names you've definitely heard of: Goldman Sachs, J.P. Morgan Chase, Morgan Stanley. These are the gatekeepers of Wall Street. They help companies go public through IPOs or initial public offerings. In doing so, they have a huge say in setting the initial price of a stock, and they often allocate the most sought-after shares to their biggest and best clients. They also act as market makers, facilitating a huge volume of trades, and their research reports can make or break a company's reputation overnight. A buy rating from a top bank can send a stock flying, while a sell rating can be a death sentence. This gives them a powerful, almost godlike ability to shape market perception. But let's venture into even shadier territory. Let's talk about hedge funds. These are private, often secretive, investment pools for wealthy individuals and institutions. They're famous for their aggressive, high-risk strategies designed to generate massive returns. One of their most notorious tools is short selling. This is where they bet against a company. They borrow shares, sell them, and hope the price drops so they can buy them back cheaper and pocket the difference. Now, this can be a legitimate strategy, but it can also be used to manipulate the market. A hedge fund might initiate a massive short position and then launch a public campaign to drive the stock price down. They might release a critical research report highlighting a company's flaws, sometimes legitimate, sometimes exaggerated, which causes a panic. Other investors see the price falling and sell their shares, which accelerates the decline, and the hedge fund cashes in on the chaos they helped create. It's a classic case of a self-fulfilling prophecy. And this brings us to another dark art: high-frequency trading, or HFT. Picture this: computers, powered by complex algorithms making millions of trades in the blink of an eye. We're talking microseconds. These HFT firms co-locate their servers right next to the stock exchange servers to get a speed advantage of a few millionths of a second. That tiny edge allows them to see buy and sell orders coming in and jump ahead of them, a practice known as front-running. They can buy a stock and sell it back to you for a tiny fraction of a cent more, but when they do this millions of times a day, it adds up to billions in profit. They aren't investing in companies, they're just skimming from the flow of the market. It's a high-tech game that the average investor has absolutely no chance of competing in. So you might be thinking, this sounds unfair. Where are the regulators? Well, we have the Securities and Exchange Commission, the SEC. Their job is to be the police of Wall Street, enforcing rules against things like insider trading and market manipulation. But many argue the SEC is perpetually outgunned and underfunded. They're trying to regulate a multi-trillion-dollar industry with a budget that's a drop in the ocean. The fines they levy for misconduct, while they may sound large to us, are often just a rounding error for these massive firms, simply the cost of doing business. It's a classic David versus Goliath battle, and Goliath usually has better lawyers. And let's not forget the revolving door phenomenon. Regulators from the SEC or other government agencies often leave their public service jobs for multi-million-dollar positions at the very banks and hedge funds they were supposed to be policing. This creates a cozy relationship and a potential conflict of interest that can lead to lax enforcement and rules that favor the industry. But here's the thing. In the last few years, a new, unexpected player has entered the game. Us, the retail investors. The dumb money, as Wall Street used to call us. Through platforms like Robinhood and Reddit communities like Wall Street Bets, everyday people have shown they can organize and become a market force in their own right. The GameStop saga in 2021 was a turning point. A massive community of retail investors rallied together to buy up shares of GameStop, a company that many hedge funds were heavily shorting. They drove the price to astronomical heights, causing billions of dollars in losses for the short sellers. It was a rebellion. It was the little guys showing the giants that they could fight back. This event proved that when millions of small investors act in concert, they can challenge the dominance of institutional players. The game has changed. The internet and social media have democratized information and communication, allowing for a level of coordination that was once impossible. While institutions still hold the most power, they can no longer ignore the collective will of the retail crowd. So, who really controls the stock market? The answer isn't a single person or group. It's a constant, dynamic power struggle. It's a tug-of-war between the institutional whales with their mountains of cash, the high-speed algorithms that trade faster than a nerve impulse, the hedge funds playing in the shadows, the regulators trying to keep them all in check, and now, the rising force of the united retail investor. The market is a reflection of this complex battle. What does this mean for you, the average person trying to build wealth? It means you have to be smart. Understand that the deck might be stacked, but it doesn't mean you can't win. Focus on a long-term strategy. Invest in solid, well-run companies you believe in, not just the latest meme stock. Diversify your portfolio so you're not wiped out by a single bad actor or a market swing. And most importantly, keep learning. Knowledge is your best defense against manipulation. The world of finance can seem intimidating, but by understanding the forces at play, you empower yourself to make better decisions. The game is complex, but it's not unwinnable. Thanks so much for watching today. I hope this gave you a clearer picture of the powers that shape our financial world. If you found this interesting, do me a favor and hit that like button and subscribe for more deep dives. And let me know in the comments, who do you think holds the most power on Wall Street? I'd love to hear your thoughts. Until next time, invest wisely and stay curious.